right, hello everyone, and welcome to today's Dynamics 365 Tech Talk. Today's topic is Fireside Chat, Inventory Costing in Dynamics 365 Supply Chain Management. My name is Erin, and I'll be your moderator today. We are broadcasting this session through Teams live events, and the audio can be heard through your device speakers. The session is being recorded on behalf of the Microsoft Corporation. When you join this event, your name, email address, and/or phone number may be viewable by other session participants in the attendee list. By joining, you are agreeing to this experience. The recording will be available on the Tech Talks Community Dynamics page within about 5 business days. If you have questions for the presenters or need support, please use the Q&A panel located on the right side of your screen. Our presenters will be responding to your questions throughout the presentation today. Thank you for your patience during these announcements. Presenting for us today from Microsoft, we have Anne Krupke, Senior FastTrack Solution Architect, Rachel Profitt, Senior FastTrack Solution Architect, Ban Lau, Senior Program Manager, and Lin Yang, Senior Engineer Manager. Anne, over to you to kick things off today.
Thanks, Erin. I'll start by doing a quick reintroduction of myself. For those of you who haven't met me yet, my name is Anne Krupke. I'm a Senior FastTrack Solution Architect here at Microsoft. You can see my contact information and my LinkedIn. Feel free to connect or give me a shout out about our mutual love of all things costing. Rachel, you want to introduce yourself?
Yes, thank you so much, Anne. For those of you that don't know me, my name is Rachel Profitt. I'm a white female with long red hair that's down today. I am wearing a red, white, and blue plaid shirt, and I'm in my office with my epic sticker wall behind me. I do have my contact information here on the slide, and I do invite you to connect with me on Twitter, check out my YouTube channel at Dynamics 365 Unboxed, follow me on LinkedIn, or check out my blog at dynamics365lady.com.
Thanks, Rachel. With us today, we have 2 members of the product group. We have Ban Lau, a Senior Program Manager, and Lin Yang, Senior Engineering Manager. They are going to help us answer our questions today. Thank you so much for joining us. And as always, if you have questions or feedback for the product group directly, you can join the Yammer Dynamics 365 Insider Program and specifically go to the Cost Accounting and Cost Management group to ask your questions and provide feedback. This is the eighth session in our Tech Talk series on inventory costing in Dynamics 365 supply chain management. You can see we've covered everything from the basic setups for inventory accounting, the various cost models that are available, manufacturing accounting, the inventory close process, the new global inventory accounting add-in, and production variance analysis. In general, we are expecting to keep the Q&A covering the different topics that we've already covered in this Tech Talk series. If there are questions outside of that on things like cost accounting or other costing topics, we will do our best to answer those questions in this session. And if we can't, we'll make sure to follow up. And because it wouldn't be a Rachel and Anne Tech Talk without it, we have a riddle of the day. And today it is, what did the flame say to his friends when he felt love? So keep that in the back of your mind. We'll come back to the answer at the end of this session. With that, I'm going to hand it over to Rachel for an announcement.
Thanks, Anne. So during our Tech Talk series, we had more than 300 questions submitted throughout each of the sessions. We compiled all of these questions, and we've created a new inventory costing frequently asked questions page that's available on Docs that will answer more than 90 of these questions. There were a lot of common themes among the questions. This article will be published later this week and will be a great resource that you can use to get your questions answered. We're also working on a new frequently asked questions page specific to the global inventory accounting add-in, as many of your questions were specific to the new feature. So be sure to keep an eye out for that new page in the coming weeks. And I'll be sure to be posting about this new page once it's available on social media.
Thanks, Rachel. We're going to start our session today covering the pre-submitted questions that were asked through our AKA link that we posted with the session registration. I want to make sure that for those people who weren't able to attend, we hit those questions first, and then we will transition into the live Q&A portion of this session. Our first question is there a report to prove the weighted average cost computation? What's the best way to analyze weighted average cost for a product after closing? I'm going to hand it over to Ben to answer this question.
Yeah, thanks, Anne. So actually, there's no specific report in the system that is meant to show the weighted average calculations. And the inventory value report does include an average value unit cost as an option, but it depends on the pyramid setup. The recommended way to understand the weighted average calculation is to, after the closing, is to go to the weighted average inventory closing issue transaction and view the Cost Explorer report. And actually, Anne and Rachel already show an example of the report in the 5th TechTalk in this series on the inventory close process. So back to you, Anne.
Thanks, Ben. Our next pre-submitted question is, how do you implement a loaded standard cost with cost roll-up details in the ERP without creating a cost price variance? I'll take this question. The answer is for standard cost, if you load prices manually, there's no way to prevent a variance from being posted when you have transactions that occur. For any items that you're going to use standard cost as a cost model, we recommend using the cost calculation function instead of just loading prices if you don't want to see that variance. In the case of purchased items, you can load the base purchase prices on the release product and then run a cost calculation to assign the indirect costs for the cost of purchase. And for manufacturing items, we covered the cost calculation process in part 4 of this Tech Talk series, the different components that add up to that overall cost. The next pre-submitted question we had is, what is the best way to clear negative on-hand quantity arising due to allowing negative physical inventory in your item model group? Rachel, why don't you take this one?
Sure. So it's recommended that you monitor and correct negative inventory on a frequent basis when your organization or business requirements dictate that you allow that your inventory can go negative. You can correct the inventory values by performing a cycle count, posting an adjustment or movement journal. And if you need to recognize the unexpected gains in inventory into a specific general ledger account rather, or main account, you should plan to use the movement journal. Otherwise, when you use the cycle counting process or the inventory adjustment process, the system will post the adjustment to inventory into the inventory receipt and offset to the inventory expenditure profit accounts that you specify on the inventory posting profile.
Thanks, Rachel. Our next question is, why is costing per location no longer allowed? Ben, can you answer this question?
Yes. Actually, the ability to track the financial inventory to the location level is deprecated from Dynamics 2012. The reason behind it is because due to the tracking inventory to the location level, it will cause some kind of issue with the financial inventory and provide inaccurate information on the true cost. And actually, this has been published in the LCS solution. I will just paste the link in the chat so you can see it. Thank you.
Great. Thanks for that answer. Our next question was, is there anything new not already released that we can talk about which is coming for inventory costing and Dynamics? Lynn, can you take this one?
Yeah, sure. So our current focus for roadmap is adding FIFO support for global inventory accounting, which is planned to be part of Wave 2 2022. So if there's any feedback you would like to provide for future release waves, please add an idea at ideas.dynamics.com. Thank you, Anne.
Thanks, Lynn. Rachel, can you post in the chat the link to the ideas site for anyone who doesn't have it?
Certainly.
Thanks. Our next question is, can costs be copied across costing versions using a batch job? Rachel, do you want to answer this one?
Yeah, absolutely. So currently, the system does not support copying prices in a cost version by using batch processing. If this is a requirement for your users, we suggest that you log an idea at experience.dynamics.com/ideas, and the product group will review during the future release planning. It's also possible that you can create an extension using X++ to execute this requirement.
Great. Thanks, Rachel. Our next question is, if one legal entity is using standard cost and another legal entity is using LIFO or FIFO, how do you reconcile that for financial reporting? Our asker was told that this is a requirement for IFRS. Dan, can you answer this question?
Yes. Actually, the new global inventory accounting add-in is designed for this very type of the scenario. It allows the companies to report on inventory using multiple cost methods when you need to meet a standard like IFRS. However, the FIFO and the LIFO support are not yet available in the GIA. Just like Lynn just mentioned, the FIFO is planned to be supporting the Wave 2 of 2022. And for more information of this service, you can just access the recording of the TechTalk on the topic on the Dynamics community site. Thank you.
Thanks. All right. And our next question was, how can we make sure that results are posted to a specific department or cost center? Right now, standard cost works so that the cost center is derived from the material. Well, you might want to allocate the results to the department that is performing the production or rework. Rachel, I'll hand that one over to you.
Sure thing. So the flow of financial dimensions on a production order is complex and can follow different paths depending on the configuration and dimensions that you have selected. To help explain the flow of financial dimensions on a production order, I've prepared a process flow to help explain the process. But keep in mind that if the out-of-the-box dimension flow does not meet your specific needs, you can consider using the cost accounting module to allocate your costs differently, or you can consider using the ledger allocation rules feature in the general ledger module to help meet those requirements. So let's take a look at this process flow. I've put together a reference that you can use to help understand the flow of financial dimensions through a production order. The flow will start at the bottom and work its way to the top of the diagram. So, when you create a new production order, the system will use the financial dimensions that you specify on the release product for the finished good. The dimension that you specify on the release product can be found on the Financial Dimensions Fast tab of the production order. You can override this value on a specific production order if required. Now, when the production order is created, a BOM or formula and route are copied to the production order. If you had specified a dimension on the finished good release product, this value is copied to all the BOM or formula and route lines, and thus the value on the production order wins, so to speak, and it's the dimension value that will be used for all future transactions on the production order. If you did not specify a dimension on the release product for the finished good, the production BOM or formula lines will use the financial dimensions on the release product for the raw materials or components. You can override the dimensions on the production BOM or formula lines from the defaults, and the values you specify will be used when posting picking lists. The lines of the picking list journal can also be overridden. If you need to change the dimension values on a specific journal, you can do that as well. The route lines follow similar rules that the BOM and formula will follow. However, for a route, the financial dimensions for each route will come from either the resource or resource group. The resource is always more specific. So if you specify a value on the resource group, you can override the value on a specific resource. The values are copied to the production route, but if you have a dimension on the release product for the production order, it will override the value on the route lines. You can also override the values from the production route when you post a specific production job card journal or route card journal. When you report a production order as finished, the system will always use the financial dimensions on the production order. You cannot override the dimensions in the journal lines or on the report is finished dialog. So if you need to change a financial dimension for the report is finished, you would need to do it directly on the production order before you perform the update. The financial dimensions for indirect costs come from the costing sheet directly. There is no way to override the financial dimensions for an indirect cost. However, if you have a financial dimension on the production order, that value will be used in addition to the dimension on the costing sheet. However, if the dimension on the production order is the same dimension that you specified on the costing sheet, the production order value overrides the costing sheet. For example, let's say you specify an item group dimension on the finished good and production order. Well, the costing sheet specifies a cost center. The system will use both the item group and the cost center dimensions. But if you specify a cost center on the released product for the finished good, that value would override the value you specify on the costing sheet. This same general rule applies to all financial dimensions and defaulting and overriding rules, as each financial dimension is evaluated independently. Finally, are the standard cost dimensions. When you use standard cost for the finished good on the production order, the system will follow the financial dimensions of the component that caused the variance. For example, if you substitute a product, the substitution variance will follow the financial dimensions in the BOM or on the product. Whereas if you substitute a resource on the route, the financial dimensions for the variance will follow the resource or resource group. If you need your standard cost variance to use specific financial dimensions, the route or BOM lines that the variance is related to should include those financial dimensions.
Thanks, Rachel, for that overview. That was very comprehensive. Our next question is, why is it that we can convert from periodic cost models like LIFO or FIFO or weighted average to standard cost, but not the other way around? I'll take this answer. The short answer is standard cost doesn't look at any previously occurring transactions to determine what the cost of an issue or receipt is. It just looks at the standard cost at the time of posting that's active for that date range. So when we change from a periodic model to standard cost, all we really need is, like I said, that standard cost that we're going to use for those transactions. To switch from standard back to periodic costing or to periodic costing for the first time, we would need to go back and look at historical costing layers to figure out what our inventory issues should be valued at based on the receipts and the heuristic defined by the periodic costing method, which would be really complex and not necessarily accurate. So that's why the change isn't allowed in the system to go from standard to periodic costing. If you do need to make this change from a business requirement perspective, the recommended method of doing so is to create a new item with your new cost model and then do an inventory journal to reduce the inventory of the old item and increase it with the new item. Our next question is a scenario. So in this case, one legal entity has two sites. A semi-finished product is produced in site 1. After production is finished, the items are moved to site 2 so that it'll be consumed in order to make a finished product. From a costing perspective, I want to have a full cost price explosion starting from the finished product. How should this be achieved? Rachel, why don't you take this one?
Sure thing. So keeping in mind that costing versions are always site-specific, you'll need to start at the lowest level of your BOM or formula. You can consider using the BOM calculation groups to help make this process easier. You'll need to run a cost calculation at the lowest level, and then you can use the copy feature on the costing version to copy the costs to the other site. After you've copied the costs into Site 2, for this example, you can run a cost calculation on the next level of your BOM or formula. You can repeat this process as many times as necessary to handle the multiple levels and sites of your production process.
Great. Thanks, Rachel. Our next question is, can you elaborate on cost price during BOM or retail kit unpacking? How is the cost of the BOM distributed between kit or BOM components? I'll take this one. When we use a BOM journal to disassemble a kit, the kit level item is going to be an issue transaction from our inventory, right? Because we're decreasing the amount of inventory we have. And that issue transaction will be valued using the normal heuristic for the cost model. So for FIFO, we'll get a FIFO update for the issue transaction. For standard, we'll issue it at the standard cost. And the kit components are all going to be receipts into inventory at their default item price, which is a topic we covered in the second Tech Talk in our series. Default item price is what the system uses when the on-hand inventory or the running average is 0 or negative. So typically that's the cost price field on the item record or the active price in the current costing version. Retail kit orders for assembly or disassembly just use BOM journals in the background. So if you're unpacking a retail kit, it's going to follow the same process of assigning costs that a BOM journal does. And our last question that was pre-submitted that we are going to cover is inventory close required? This is a super common question we get all the time. So the wonderful Rachel Profitt actually put together an answer on her YouTube channel, which we'll play for you now.
Hey, Anne, I think we just are missing audio.
Yeah.
We can't
We're
hear
not
that.
getting the audio of the video.
Okay. Let me restart the video.
Series.
Can you hear it?
Yes.
Is the inventory close required?
I'm glad so many people asked this question during my latest Tech Talk series. In short, yes, the inventory close is required. If you plan to use the new inventory archiving features, the system checks to ensure the close is performed. But even if you don't plan to use this new feature, we strongly recommend that you run inventory close no matter what your costing methodology. It closes inventory for new transactions, revalues your inventory to the heuristic model that you've selected, and closes out the inventory transactions, just to name a few things. If you have a burning question, be sure to submit it in the comments. And as always, thanks for watching Dynamics 365 Unboxed. We'll see you next time. Don't forget to like, subscribe, and share.
Great. Thanks, Rachel. There we go. Oh, no. We don't want it. It was a great video, but we only need to watch it once. Okay, so that wraps up the pre-submitted questions that were asked beforehand. So thank you to everyone who submitted a question. With that, we are going to take a transition over to the live Q&A panel. I see we only have one question so far. So if you have questions, now's the time to submit them, and we will start answering those questions live. Okay. Our first question that was asked is, how can you access the previous Tech Talks in the series? That's a great question. And the answer is that they are all posted in the Dynamics community site, and we can get a link posted in the chat to give that link to you so you can access it. So Rachel, can you pull that link up and post it in the chat?
Yep, I'm working on it right now.
Great. We'll give it just a minute while we wait. We have no other questions in the queue, so if you have a question, now's the time to ask it.
And we could certainly move on to some of the FAQ questions while we wait. So we've got a lot of time here. Be sure to submit those questions that you have, and we'll work to get those answered.
Okay. Oh, here they come. Okay. This one is a little bit off topic for costing, but we can help address. The question is, I was asked by a prospect if D365 FinOps supports DDMRP. That's a really good question. And just to kind of recap for anybody who might be curious, DDMRP relates to a certification of the master planning functionality in a software solution. It's governed by the Demand Driven Institute. It's not something that we currently have in Dynamics, but it is on the roadmap, I think, currently for Wave 2 of 2022. So that's the answer to that question. Our next question is, if I didn't mark run recalculation after closing during the inventory closing process, does the closing process adjust your weighted average cost, or will it not be affected? Rachel, do you want to take this one?
So I just want to make sure I understand the question. If I didn't mark run recalculation.
Mm-hmm.
Okay, so if you don't choose the option to run recalculation after closing, the inventory closing and an adjustment process is only going to evaluate transactions with financial dates that are equal, or I should say, equal or less than the date that you are closing inventory. So if you have transactions that are after your closing date, so let's say it's the 10th of the month today, and you're running the inventory closed for the 30th of April, I will only adjust and recalculate values that have financial dates less than or equal to 4/30. But any transactions that occurred between the 1st and the 10th of the month will not be revalued and adjusted. So that's the advantage to using that run recalculation after closing process, is that it will, up until the current system date, it will run that adjustment. It can always be adjusted again when you run the next close, but it will actually perform that adjustment to weighted average for those transactions up to the current date that occurred after the closing date.
Thanks, Rachel. I think it's good to point out that what you kind of said at the end there, you will get the right weighted average cost when you run the close for those future dated transactions, right? So like we talked about in our previous Tech Talk, recalculation will give you the most up-to-date values of what your cost would be. But ultimately, when you run a close, it will set everything to right, regardless of whether you ran the recalculation during the period or not. Although we do recommend for periodic models that you run recalculation throughout your period. Our next question is, what recommendations do you have for a company that uses production with projects and FIFO, and they want to be sure the cost doesn't change on their projects? So I'll start with this one. If FIFO is the cost you're using for materials, then you can't prevent your cost from changing, right? By picking FIFO as a method first in, first out, we are essentially saying that we want the actual cost of our inventories and therefore the changes in our purchase prices, for example, to be reflected in the cost of our issue transactions. So in general, the response, if you're looking to keep the cost the same, would be to use standard cost. Now, for certain customers I've seen in the past in manufacturing, they may have FIFO for raw materials, but have their finished good be standard cost. so that the margin and the cost of goods sold is consistent, but they can still take the fluctuating cost of materials into the overall cost of production. Rachel, do you want to add anything to that?
Yeah, I think the only other thing that I might add to that is like if you want your FIFO costing to be more real time, is you can consider running that recalculation process on a daily basis so that we revalue those transactions to the FIFO value every time you run that recalculation. That will help keep it more real time. So it's still going to change from the running average to the FIFO value, but you'll get that much more frequently if you run that recalculation on a daily basis.
Oh, okay. So I understand. I read that question as you want the cost to be the same from project to project, but I think we're asking here when we posted the running average and then we update, it changes the cost. So what Rachel said, it made a really good point. And there is another avenue to be considered, thanks, Anders, to use marking. So if you use marking on transactions, you can have the actual cost of the transaction linked immediately when the transactions are marked, and then that cost value won't change as time goes on.
Yeah, that's another great point.
Okay, our next question is, what is perfect fit industry for the moving average method? I'm not sure what that question is asking. Rachel or Ben or Lynn, do you have any idea?
I'm not clear what that means. I've never heard perfect fit industry, that terminology before. I don't know, Anders, if that's maybe something you're familiar with. If whoever submitted this question, if you can maybe try to clarify a little bit more in your reply, we can certainly try to come back to this. Anders, did you have a thought? I see you came off mute, Anders, but we can't actually hear you. Okay. Why don't we come back? Oh, now we can hear you.
Yep. Okay. So you said what perfect fit? I just wanted the first part I didn't get. Yeah.
The question is, what is perfect fit industry for moving average method?
No, I think they're saying where, okay, if I rephrase it, I think where in which industries is moving average a perfect fit? Is that how we should rephrase it, I guess? Just so moving average is used heavily in industries of distribution or for raw materials where you have a high volatility in your product. And you don't want to wait for the closing to give you the right cost. And standard cost is not good enough because standard cost is set by quarterly, half-yearly, yearly processes. So moving average is giving you a volatile costing method in real time, and you will never have to recalculate. It's given at the time you consume the material. So that is the benefit of the true moving average, is that it gives you the cost. And if you have volatile raw materials, you will immediately see that affecting your production cost. And you can have moving average on your produced items. We have written some recommendation for when to use moving average for your production orders, but it simply means that your cost of your raw material prices will faster goes to your finished good.
Okay, thank you. That I think that interpretation of the question makes a lot of sense. So thanks for that, Anders. Our next question is, if you set financial dimensions in a production order, but you've also set them in a finished good, how and in which process will each one be used? Rachel, do you want to take this question?
Sure. I think we answered this with a big diagram that we looked at just a few minutes ago in our tech talk. The short answer is that if you put a financial dimension on the released product, so the finished good released product, those values will default onto the production order, and that dimension will also default to all of your BOM, formula, and or route lines, which will then default into your picking list journals, route and job card journals, and so on. So if you put dimensions on the release product, they're going to flow through and that will be used. If you want dimensions to come from the raw materials, you can specify those, but you need to make sure that if you want the raw material dimensions to be used, and you also want a dimension to be used for your finished good, you'd need to be using two different financial dimensions, because the system will, whatever financial dimensions are on the production order will override any of the kind of line level dimensions that you have. But if you have two different dimensions, one for raw materials and one for finished goods, they can both be used because we evaluate that defaulting logic for each dimension exclusively.
It's probably also worth pointing out, Rachel, that the financial dimensions on a release product, especially for a finished good, are used in other types of transactions than just production, right? So you need to think about things like how do you want your sales order financial dimensions to populate, or other types of inventory transactions when you're considering whether or not you want to set financial dimensions on the product level.
Absolutely.
Okay. We recently had a question from a customer about how inventory cost is calculated for weighted average for unlinked returns. I'm going to assume that that means return orders that are not linked to the sales order that sold them. So whether does it take the running moving average as the cost, or the item cost on the release product record? And is that updated at inventory close if you're using a periodic method? Rachel, I know you did some testing on this one recently, so do you want to take that one?
Sure. So if you create a return order that is not linked to a the original sales order, the system is going to treat that return order like any other receipt. So it's obviously, depending on the costing methodology you use, it will change kind of that behavior. If you've got a costing version set up, the system would use that. If you don't have a costing version, it will look to the price field on the manage cost tab of the release product, and that would be the price that it would use for that receipt. Obviously, the behavior is different if it is a linked return, because we actually look to the original sales order and use that price. So that return is a receipt into inventory, and further issues will then be settled against that receipt based on the heuristic model you've selected. So if you've chosen weighted average, that receipt or that sales order return would be treated just like any other purchase order, and the cost that's defaulting in there is the cost that comes from the manage cost tab on the release product.
And I think just to kind of close on the last bit of the question, which says, does it change when inventory closes run? I think the answer there is no, right? Because we don't, receipt prices are not adjusted by the inventory close process, just issued. So because it's a receipt, we've defined the cost, and that is what the cost of that will be.
You can always use the adjustment feature. Do remember that as well, if you need to adjust that receipt. So if the price was not correct, you can use the adjustment feature because it is a receipt. You can adjust the value of receipts, or you can adjust the value of your on-hand inventory.
Great. Okay, our next question. Can anyone elaborate on the output quantity-based method of calculating overhead in the costing sheet? We have found that it applies to all manufacturing orders, whether produced internally with resources that have labor rates via cost categories, or through an order that has been subcontracted using route operations. It appears this is because there's no absorption basis to take this method and link the overhead to a specific type of labor via the cost category or cost group. I know that one's kind of long. Anders, is this something that you could answer?
I got some of it. So the output quantity is really just looking at the production as whenever you report something finished, right? And you can put a surcharge on top of that, right? Mm-hmm. So it doesn't really look on anything else than the quantities, and says whatever quantity you're producing, I can put a surcharge on top of it. So it doesn't look at what your input is. It's actually just looking at that you can put a rate on whenever I produce one finished good, I put 10 cents into inventory.
Okay, so if you wanted to have an output quantity-based surcharge, but not for subcontracted production orders, is there a way to differentiate that?
I can take that. So yes, so when you're on the rate tab in the costing sheet form for an output unit based, the default, when you choose a costing version, you choose a site, the default in the valid for column is all. If you select all, the rate that you're defining will apply to all products. However, if you want to apply a specific rate to specific products or group of products, you can choose table, which will allow you to say a specific finished good item, or you can choose group. Group is referring to an item group. So if you create an item group for all of your subcontracted products and different item groups for your non-subcontracted products, you can separate by the group as well. Obviously, table is very specific and it's going to be every single item, but group allows you to kind of create those groupings. So I think in your example, group would be the best choice. You still might need to make multiple rows if you have lots of different item groups, but if you don't segregate your subcontracted production items from your regular items, there's not a way to do that out of the box. So if you produce the item sometimes and sometimes you subcontract it, we don't have a way to separate that.
Okay, I think that's the answer we have. It's a good answer. Thank you, Anders and Rachel. Our next question is with regards to the financial dimensions on production orders. Can you not add a feature that would allow to populate the financial dimension on a production order from a production group instead of a finished product, or another way? So this seems like it's a feature request roadmap. This customer or this user is asking, we're really looking here at a specific P&L per department on the production floor. Manually changing financial dimensions not really feasible, and allocation afterwards is not advisable. So Dan, is that something you can comment on? This is kind of a feature request I think we're seeing.
You're on mute, Dan. If you're talking.
Let me just try to understand the questions.
So Rachel explained in the pre-submitted section that the financial dimensions, how the financial dimensions are populated on production orders, and production orders will take it, they can take it from the finished good item, and she's going to walk through all the other ways they can do it. But this person is asking, can we create a new feature in Dynamics that lets you define financial dimensions on a production group, for example, that then applies to the production order instead of using the normal methods?
I think you can try to raise this in the ideas. Then we will take a look and evaluate if this is features available or not. We will check it. Please raise it in the ideas. Yeah.
Yeah, I think just to add to that too, you could certainly extend the solution yourself and add a financial dimensions tab to the production group page. There's not one there. And then you'd have to extend the logic when you're creating a production order as well, to pull those default dimension values from the production group. I think in this example, I would recommend that you look at using two different dimensions. So if you're wanting a P&L by department, use a department dimension that you only specify the default value on raw materials and on all of your resources and or resource groups. And then if you need the finished good to have a dimension as well, perhaps you use like an item group dimension, for example, and the item group dimension is only used on finished good products. That in that way, all the detail lines get a financial dimension. But obviously the kind of header level of your production order would not have a department. So I think that's the closest you could get without having to do an extension. But it may not still fully meet your requirements.
Okay, thanks, Rachel. Our next question is, consider you produce an item that consists of both purchased and BOM items, so other produced items. Before you start to produce, you want to analyze whether to buy or produce one of the items that the top production order consists of. Is this possible to achieve using costing versions to simulate make or buy decisions for BOM components? I will, I'll start this one, and then if anybody else has comments, they can jump in. So cost versions are useful if you want to, simulate decisions, but more from like, I would think a periodic level, right? So I wouldn't go down to I need to place an order today and decide whether it's going to be a production order or a purchase order based on which cost less, right? So we could, in a periodic process, use a couple of different planned cost versions to say, I want to run it assuming I'm going to buy these items and this is what it would cost me. And I'm going to run it assuming I would make these and this is what the cost would be. The cost versions and the costing roll-up functionality certainly would let you simulate and calculate what costs would be and compare them. But when it comes down to a very specific situation, that's not necessarily an application I would expect for a costing version. I don't know, Rachel or Anders, does that make sense, or do you have anything to add?
So I agree from the costing perspective, because again, this is not a decision that is taken by costing itself. You can simulate the different cost perspective of doing in-house or buying a component, which is correct, and the costing will be different. But you're more using it from a planning perspective of your planning capacity, right? To say, do I have the capacity to produce it in-house, or do I need to purchase that portion of the production order? Either I buy the subcomponent completely, or I need to manufacture that subcomponent as part of it. So the costing is a small part of the decision versus the planning, but the planning will now have the ability to select both options based on the capacity they have in the manufacturing shop floor. So I would say you cannot take the decision based on costing. You're taking it based on you now know your different cost points by doing it. Now you need to figure out from the planner guys in the more shop floor planning or production planning guys to take the decision of what we can do to get the most output for a given period. So it's more a planning exercise to do the what if analysis using the costing information for taking that decision.
That's a really good point, Anders. And I will add that the decision to make versus buy is not something that the master planning module at this time can recommend to a user. It is possible for you to look at a planned order and change things from planned production to a planned purchase order. So we support, reviewing manually and changing the sourcing method of components in planning, but it's not a feature for master planning to say, based on X criteria, this is what you should do if you can make or buy it. So that's not something the system does at this time. Okay. The next question is there any possibility to see the overall costs, material, labor, indirect, at the finished product level if you have multiple levels of production? Rachel, do you want to take this one?
Sure. So we did talk about this. I don't remember which tech talk in the series, but we did talk about this. I think it was the production manufacturing. But if you go to a production order and click on I'm sorry, I'm trying to make sure I tell you the right exact button. You go to the Manage Costs tab in the action pane and you click on View Calculation Details. This will open up a new screen where you can see your overview estimation. So that's your estimated costs when you started the production order, and your overview costing. So that's when you end the production order. If you switch to the Costing Sheet tab, you can obviously create a costing sheet that separates your material, labor, and indirect costs in a hierarchy in whatever technique you want. And there's a level field there where you can choose total, single, or multi. So if you want to see the full kind of multi-level BOM, multi-level production, whatever your scenario looks like, you would need to make sure that you select multi in that drop-down box. The default value when you click to that tab is single, so you'll need to make sure you change that. And then the mode drop-down box is where you choose if you're looking at the estimated or the actuals. So, and you can also choose like the quantity. If you're looking at just one unit, the lot size, which is the quantity on your production order, or you can do a specific quantity. So that's the primary way I would recommend to do what you're asking about.
I just want to add here, Rachel, there's also a new field added in Dynamics 365 in the Manage Cost tab as well, under the production order, where you see a graph, which will give you the planned cost from your costing version. You will get your estimated cost for the planners, and you will actually get the realized cost of an in the production order. And you can drill in from you get 3 pillars, and you will get your variances between the planning variances and the production variance, and then your total variance. And that's irrespectively of standard cost and actual costing, because it's a production costing. But at the same time, you can drill in to see that by material, labor, and overhead, and you can then drill in to see it by cost group as well. So this is a visual format of the form you were mentioning there before, where we actually make it on a graphical level you can drill into.
Absolutely. That button is called View Cost Comparison, and it's right below the View Calculation Details. And we did cover that in our tech talk as well. I believe it was part 7. Is that correct, Anne?
Part 4, part 7, but it was covered. Yeah.
Yeah.
Okay. The next question is, are there any new reports coming to support inventory, ledger, or ledger reconciliation and overall costing reporting? Ben, is that something you can take?
As I know, there's no new reported you can use for that purpose. For now, there's no new report.
Yeah, I think if you've got specific gaps with the out-of-the-box reports, we did take a look at this in our inventory closing tech talk in the series. The cost management workspace has a great kind of visual comparison where you can do reconciliation, as well as the potential conflict reports that we reviewed, as well as the inventory value report, which has a lot of configurable options to make that meet your requirements. If there's specific gaps that you're seeing, or something specific that you'd like to see for reporting, I would encourage you to submit those on ideas.
Thanks, Rachel and Ben. Our next question is there any specific impact of using the landed cost module on inventory costing, or does it work in similar fashion to PO charges allocation functionality in combination with the inventory costing method adopted? The assumption being all your charges are loaded on your item cost. And I'm not sure the answer to this question. Is there anyone on our panel today who is able to answer that?
So very quickly, the landed cost feature is just an extension to what miscellaneous charges is. So yes, it does work similar fashion as charges, because they are actually creating charges. The benefit is just that you can have one, the allocation methodology that we have is much greater. You can also have charges that goes across purchase orders. So you can actually now put charges on top of multiple purchase orders. So by having a container shipped from A to B, you may have multiple orders from multiple vendors in that region that you're putting into a container, and now you're shipping the container home, and now we need to actually allocate it out. So that's the allocation methodologies that and features available in the landed cost feature is extended greatly to the POs. On top of this, you can actually also do this on transfer order. So this is one of the features that a lot of our customers has requested for a very long time, that you can actually add charges on top of transfer orders. And you will be able to do that with the landed cost feature. So if you're doing internal transfers, let's take a very simplistic case of US, that I need to move my goods from the East Coast to the West Coast or vice versa for my distribution centers, I can actually intercompany-wise doing a transfer order and actually add charges, because again, I'm allowed to do that as long as it's by bringing my cost to the location of where I'm selling the goods from. So in that sense, I'm allowed to add that transportation cost on top of my inventory cost in that receiving location. So yeah, the landed cost is actually just an extension of miscellaneous charges.
Great, that's a really helpful answer. Thank you. Our next question is, a lot of legacy ERP systems capture the cost of goods sold in terms of materials, labor, and overhead in a separate GL accounts for the finished product. In D365 F&O, only one cost of goods account exists for the finished good. What options do you have to address this reporting gap in the general ledger? I want to say that there's the cost element policies within global inventory accounting might be a way to address this. Anders, is that maybe what you were going to start to say?
Yeah, I would probably be a little bit more, sorry to say, pessimistic here, saying we know this is definitely a requirement. And yes, right now, the cost of a finished good is a lump sum. So what we are doing to address this is really the global inventory accounting. The global inventory accounting is fundamentally built on that every cost is accumulated into an object, which can be an inventoried object or a produced item, once we get to the produced item as an accumulated object, where everything is accumulated by element of cost, meaning, and then you can group it by material, labor, and overhead. And thereby we know that the global inventory accounting will give us the ability for you to decide when you integrate to general ledger, whatever level do you want to actually have that to post into the general ledger. So we know the requirement. I don't have a good solution right now in Dynamics 365, but global inventory accounting is designed exactly also to cover this problematic, to where you can determine the level you want to integrate with the general ledger and thereby get your different labor material or the material as such and labor or labor details as such actually posted to the general ledger.
Great. Thanks for that answer. All right. The next question, if I have a retail chain which has its own factory producing their products, what is your recommendation for the different costing methods? Or is it better to have different item model groups with different costing methods based on the nature of the items? For example, retail items with weighted average date and factory items with standard or weighted average. So I'll start this one, and then anybody can jump in who wants to. But essentially, the choice for how to cost any particular product is going to be it depends answer. There are several kind of factors you want to think about, and we covered a lot of those in the second Tech Talk in the series, which is the inventory accounting models. It's definitely a strategy that we've seen customers use where they have different item model groups for different types of items or items that the answer to those considerations questions are different. So at the end of the day, you need to make sure that you're thinking about how you're going to report to local authorities or tax authorities. You need to check with your auditors to make sure whatever strategy you're going for makes sense. And then you need to think about all those other questions like how do I want variations in purchase prices to impact the cost of my materials? How do I want my margins to look based on the cost of goods sold that I'm assuming? So I know that's not really a specific answer. The answer is always it depends. But in the second Tech Talk in the series, we outlined a lot of those questions you should be asking yourself, which hopefully gives you a good idea of which direction to go. Anybody else on this panel want to add anything there?
I think you answered it very well, Anne.
Okay. The next question is, when running inventory close, it's possible to select specification level, total, item group, and item. Is there any recommendation of which level to choose? Rachel, you want to take this one?
Sure. I think in my experience, most often people choose the total option because what this specification option does is it changes the kind of detail in the voucher. Oftentimes we don't need a voucher to be specific to each item or each group of items. Rather, we can just go with one big giant voucher for the adjustment, and the inventory settlements and subledger will contain the details that we need to report on. If you do have financial statement reporting requirements and need to separate those, you can certainly choose to have like a lower level, keeping in mind that even if you choose total and you have 3 different item groups with 3 different inventory accounts or 3 different inventory profit and loss accounts, for example, the system is still going to separate those into the appropriate main accounts that you specified on your posting profile. So even if you select total and there's more main accounts to be used, the voucher will still be separated, but it'll just be one big giant voucher rather than multiple at the item or group level. Hopefully that answers the question.
Thanks, Rachel. It makes a lot of sense. Our next question is, if we change the costing method for the item, for items that already have transactions from WAG, which I'm assuming is weighted average, to FIFO, is there any impact on previous transactions? Anders, is that something that you can answer?
So I guess the changes from weighted average, it could be day or it doesn't matter really, weighted average. So you can do the change, and yes, even if you do a closing, there might be a slight change because you still have some transactions which is potentially only being physical at the point where you do the swap, meaning by end of a month. Normally you will do this even by end of a year, right? Because making a change like this is something where your financial teams need to be in place, and you need your financial statement, and you need your financial notes to be that we are changing it, because you will gradually be changing your inventory and your perception of your inventory valuation, right? So there will be some change, and there will be some changes in a grace period of time, because some of the items that you close down with your weighted average at the end of a year may be financially updated in the coming year. And that change of price will now affect how the weighted average will be. So you will have a grace period where you are, in a sense, in a little in between before all of your receipts and all of your issues will be only based on a weighted average principle. It's difficult to explain how much it is, but there will be a period of grace, so to speak, where some transaction can be handled in between, so to speak.
Yeah, and I think maybe a good point would be we recommend that you financially close all transactions that you can, right? So that we're finalizing and then closing inventory, closing the books on all of our previous transactions before we make the change. So you would want to take steps to make sure that it's minimized, right? When you go from one method to another method. And I do think we cover the process for changing from one inventory model to another in the first Tech Talk in this series. Okay, the next question is, for production orders on projects, why is the posting method consumed not compatible with the costing sheet? So I've actually heard this one before. Essentially, when you use production orders on projects, there are some posting settings that say when I have updates to my production order, when does that flow into the project? So you have consumed, and then I think you have another option that's essentially when I finish or end the production order, just take all the updates and post them to the project. When you use the costing sheet to apply indirect costs to the cost of production, the system doesn't let you flow cost updates to the project as the updates are consumed, or costs are consumed on the production order. So this is a gap. This is a known gap in design, and I don't know if I can answer the why. I can confirm it's a gap and that it's not on the roadmap at this time to allow that kind of like real-time flow of updates, including indirect costs to the project. I'm not sure, Van or Lynn or Anders, if any of you know why that's a gap. I think that's a no. But again, as we said a couple times, if you are interested in having this feature reviewed and potentially added to the roadmap, you can add or upvote ideas on the ideas portal. Okay. The next question: if the finished product is using standard cost as the cost method and your ingredients are using weighted average, what's the result after recalculation? So I can take this one as well. Or Rachel can. Okay, go ahead, Rachel.
Yeah, sure. So if your finished product is using standard cost, the inventory close and adjustment will have no effect on the cost of the finished good. However, the raw material components that are being consumed in those production orders will be revalued at the weighted average. So when you run a cost calculation to determine what the standard cost is, that's the standard cost that's established for the finished good. Your raw materials would be revalued at whatever the weighted average is based on, the receipts and issues for those raw material components, but it does not increase or decrease the variances, for example, in the standard cost item. The variances are determined between what's the difference between the standard cost and what was actually consumed on that production order. Hopefully that answers the question. I don't know, Anne, if you have anything you want to add.
I know we tested this one. I think we said it right. The ultimate answer is standard cost is the standard cost for your finished good. That's going to be the cost in inventory of your finished good item. But the raw material cost will still be adjusted to reflect your standard cost or your cost model heuristic, like Rachel said. The next one, when working with a standard cost price per variant for purchase goods, we're not able to efficiently identify different purchase prices. Why is it not possible to use the trade agreement purchase price as the base price for standard cost calculation? Often, the procurement department uses the trade agreement functionality, so it would make more sense if you could define a different purchase price per variant here. So maybe I'll kind of clarify a little bit. You can use the purchase price field on a released product to calculate a standard cost, which then includes an indirect cost as well for purchase items. When you use product variants, you have only, again, still just the one purchase price field on a released product, right? So if different product variants have different purchase prices, there's no way to reflect that on the released product form in Dynamics itself. So you have to pick one, and then you're going to end up with a bunch of variances. So I don't know if anyone has, Anders, maybe you have a response to this.
Yes, so you can still go into the costing versions. You still have that you can actually create a purchase price in the costing version for each of the variant, and then create a calculation, and you will get a standard cost for each of the variants based on your costing sheet. So if you have item X color black cost in purchase $10, but if you buy it in gold, it costs $20. You can actually do that by using the costing versions themselves. You just go to the purchase price and insert purchase price in the costing version, and then you can run a calculation, and you will actually get the cost calculated. So it is possible to do that with costing versions. I must admit, it's so many years ago, so I don't recall why the trade agreements was not triggered and being called by the costing version cost calculation. There was a good reason why, but it is, I guess, 15, 16 years ago, but there was a reason why we didn't do it. I simply cannot recall it.
Okay.
Yeah, so I can maybe add a few more things. So like if you do have the ability to make trade agreements that are per the variants, you'll need to, on the product dimension group, enable the for purchase prices checkbox for each of the variants that you want to be able to set up a purchase price for. And to Anders' point, we don't automatically use them. However, if you need to be able to set up purchase prices per variant, you'll need to enable it on the product dimension group. And then if you want to use those costs in your costing version, you could certainly look to use like the export functionality. So export to Excel, and then, delete the extra columns, put your costing version in, and import them into the costing version so that those trade agreement prices can be used, but it would be a manual process, and you'd need to make some decisions to make sure that you're setting up those purchase prices in the costing version appropriately to be able to do those cost calculations.
And one last point of clarification, if we use the purchase price in the costing version to calculate the cost price for different variants, but we also have purchase trade agreements for the different variants. When I create POs, the system will use the purchase price in the trade agreements. It will not use the purchase price in the costing version. Right. So just want to make sure that we've fully closed the loop on that one.
Yep.
Okay. This is a really good question. In weighted average date, the costing method, when we run the close, the system posts the weighted average inventory closing transactions. But when we run a recalculation, it does not post those transactions. So what difference does that make in cost calculations? Bless you.
Thank you. So you've made an absolutely correct observation. Even when we make adjustments for FIFO or LIFO or any of our periodic costing models, the recalculation does not create those settlement records. It's only making adjustments. And that's because it's temporary. We don't make that final settlement and that weighted average inventory closing transaction until you run the inventory close. So those adjustments are adjusting the value of those, and you are getting a voucher. So the cost in your ledger is reflected. And the adjustment amount on a new transaction, right, we're using the running average. We're not even using the weighted average or weighted average date or FIFO, right? We're using a running average, so it doesn't affect the running average. The running average is still the running average. So it's not until you run the inventory close that it becomes finalized. So this is especially important if you backdate transactions. The adjustment that was made to any specific receipt could change when you run the inventory close at the end of the month, for example, if you had backdated any transactions, and now the new calculation for the weighted average is slightly different. Hopefully that answers the question.
Thanks, Rachel. The next question is, in the production order ending process, can I allocate scrap cost on a scrap count if I'm using the weighted average method? So my recollection is it doesn't work with standard cost. I'm not sure if anyone knows whether it works with weighted average specifically.
As far as I know, it does. I don't know, Anders, if you can confirm or ban if it works differently for a weighted average. But as far as I know, if you select the scrap account option in your production control parameters and you're using a periodic costing method, you can specify the main account where the scrap variances get posted to.
Yeah, it should work for all the different periodic costing methods. It should primarily, as I remember, it couldn't be standard cost where you cannot, because we are posting it as variances. That's at least how I remember it.
Yep. Okay. Great. Are there any changes coming to the costing sheet functionality? So I'll just take this one to answer quickly. We had an earlier question where Ben talked about this, but right now the only thing on the roadmap for costing is to get FIFO support and global inventory accounting. So there are no specific roadmap items for costing sheet functionality, but of course we would love to hear your feedback on the idea site if you have specific gaps or requirements that you'd like to see filled. Okay, the next question is, how can we enable other regions' inventory reports, and why doesn't Microsoft enable those reports by default? For example, the inventory status report for China.
I think the general answer is that globalization features are controlled by the legal entity and the country that you select on the legal entity. So if you have a legal entity where the primary address on that legal entity is in the country of China, all of the China-based globalizations and localizations will be enabled in that legal entity. We don't have any functionality to enable globalization features across multiple companies or have multiple localizations within a single legal entity.
Thanks, Rachel. Let's knock out, we're kind of running down to the 10-minute mark, so let's knock out a couple of these shorter questions. Is it possible? Oh, okay. So the question is it possible in the future to run inventory closing on an item number or item group only? So right now you can only run inventory close for all items at once. You can recalculate for items, item groups, or all items, but inventory closing is for everything. And as we said before, there's nothing in the immediate roadmap around that. Is there, let's see. Here, Rachel, why don't you take this one? Why doesn't moving average need an inventory close?
So the moving average is it's not a periodic costing method. It is a
perpetual.
It's a real-time methodology, right? It's the cost that's used at the point in time that you post that issue, that sales order, is what's used. And so the inventory close does not revalue it. We still recommend you run the inventory close to prevent backdating of transactions, which is a common problem that we see with moving average, is people backdating transactions and then wondering why that backdated transaction doesn't have an effect on the moving average and the path, like the kind of in between transactions that happen. So we still recommend you run that close.
Thanks, Rachel. Would it be possible to have standard cost by warehouse? As far as I know, this is not possible. And I'm seeing nodding heads. So, yep. Okay. Let's see. Some clients of mine don't always have cost prices when a first receipt is done. So using standard cost is a big issue. Do we advise FIFO plus fixed receipt price here, or what would we advise for the item model group? So I think I'll start, but when we don't have, we should try to use the default, right? We want to pick the cost model that makes sense in perpetuity, right? Not just thinking about getting started up, but we want to think about the overall cost model that's going to work. And then while we don't necessarily if we're in a situation where we don't have a running average or a receipt price for our first few issues, that's where we want to use the default price logic. So the release product field for a price, the active cost and the cost version, or if you're using moving average, you've got the last issue cost price that you can use. So my general answer would be use the right cost price or cost model for your business, and then use the default price as a backup for the first issues that come through. Or you could consider including physical inventory, but that's a decision that you need to make yourself, right? Rachel, anything to add there?
No.
Okay. Can we talk about how inventory aging report calculation works? Like which date is the base and how are the quantities moved to the correct buckets? Who wants to take that one?
I can off mute. Yeah, I can take this one. It is using the physical date of the transaction, and depending on the level of inventory hierarchy, meaning if you're using warehouse and you have transfers to a warehouse, we will actually show you a transfer into the warehouse being a change of the aging of the item, because we want to show when this product actually received into this warehouse. If you're looking at the side level and you have transfers between the warehouses, we will net them out, saying that they never actually transfer. So we are not re-aging the item when you are transferring between warehouses on a site. So that's one of it. But I would still go, there is actually a pretty good white paper that was written when we did this. I think, again, the white paper probably mentioned, I think it's 2012 R3 or something like that, if I remember correct. It's many years ago. But that white paper is still how the report works. But fundamentally, we calculate the physical inventory first, then we calculate the financial inventory, and then we really calculate an average cost of all the inventory that is aged, and then we actually tell you what is the value of each of the bucket. So we are not using like there were some old aging reports in the product, which actually use the inventories and the cost on each inventories to figure out the value in each bucket. So the new aging report is actually using the quantities, and then we're using today's date inventory value, find an average price, and then we are calculating the value of each of the buckets. But we are using the physical date as the date to determine the age of each inventory quantity, so to speak. But again, I would recommend the white paper that was written about the inventory aging report. You can search for it in Bing or Google and find it. It's still applicable. Okay.
Thanks for that. We can also take a look to see if we can dig up the link and post it in the chat. All right, let's try to get through a few more. We are running close to time. So someone asked, I run inventory closing every month end, but I never ran an inventory recalculation. Is there any risk or downside of not doing it? So the short answer is, if you're running inventory close, you're getting the right costs assigned. So that's the important thing. Inventory recalculation lets you have a more up-to-date view on costs throughout the period. So, when you're looking at interim reporting, it's going to be more accurate to what you'll see once you run the close, but there's no specific risk from not running it other than lack of visibility. Yeah. Okay. Anders, I know, so you talked about white papers from 2012. Do you know if there's one? Someone asked, can you explain the parameters for the check prices report? They haven't been able to find any documentation for D365.
Can you repeat that one? Can I read it?
The check prices report.
On the inventory closing, is that the one?
Yes.
That is a paper written about the closing process, And I'm pretty sure that report and how you run the report is part of that white paper, a closing white paper that was written. And again, this report hasn't changed for a long time. So yes, I've seen it, but again, it's years ago, but it should exist.
Okay. So I don't think we have an answer right now for that question, but we will follow up and we'll make sure to include that in the FAQ, the next version that we post. Okay. Our next question is there a way to simulate the results of ending production orders and post purchase orders and then close inventory just to be able to review the adjustments and then do inventory closing? So as far as I know, there isn't a way to just simulate the ending process for production. You can generate and from a closing perspective, I don't believe there is. Anders, do you have an answer other than that?
No. Well, yeah, there's nothing there. When you end the production order is ended, and that's final. No, so there's no simulation process. And I personally haven't heard the requirement, so that would be on the ideas portal a request if this is a feature that is requested as a generic feature.
Mm-hmm. Okay. Thank you. Okay, and then we have another question. We're upgrading 2012 to 365. Since the imported prices aren't calculated, we don't have visibility to the calculation details to view the indirect cost on the migrated records. So they're asking for advice. Should we just do a post cutover cost roll-up and recreate all the prices and therefore have the calc details? Or is there a better way to do this? So from my perspective, I think the proposed solution works fine. Anders, do you have another way to do that, or do you agree with the way they're proposing?
So at least what I know we have done in the past with a few customers is that we migrated all of their purchase prices, and then we executed a new calculation in the Dynamics 365, which will give you the roll-up. So you should not import the cost itself. You should actually import your purchase prices, and then you have your costing sheet, and you have your BOM, and you have your routes, and they will then calculate your new cost, and then you will have the entire roll-up. So you can specify when you do the export to Excel and the import, you can specify which price types you want to export and import. And thereby you can secure that you're only getting the purchase prices that you need, and thereby you can then execute the BOM calculation. That would be my advice.
Okay. Thank you. We're at time, so I'm going to wrap us up by just giving the answer to the riddle of the day. I will say for all of those questions we didn't get to today, we will make sure to review them and include them in the FAQ document that we will be posting. So if we didn't get to your question today, we will get to it. Thank you so much to everyone for all the questions that you asked. The riddle was, what did the flame say to his friends when he fell in love? And I think someone in the chat got it right. The answer is, I found the perfect match. So that's the joke. It's about as good as the rest of our jokes are. And with that, I'm going to turn it back over to Aaron to take us home. Thank you again for the participation, Ben, Lynn, and Anders, for your support in this Q&A.
Awesome. Thanks, Anne. All right, everybody, I've posted a link to a short survey that is in the Q&A panel. We really would appreciate your feedback on today's session, and we'd love to hear what you'd like to see and hear about in future events. Thank you so much for your participation in taking that survey for us. As a reminder, the recording of today's session will be available on the Tech Talks Community Dynamics page within about 5 business days. I'd like to extend a big thank you to all of our presenters today, and of course to the audience for joining us. We hope you have a wonderful rest of your day wherever you may be.